Hi there, it's Friday the 16th of August 2019. I'm Steve Towers. Welcome to ITB, coming to you today from Bangkok. Let's get started. As you know, the last ITB show was on the 2nd of August, which is 2 weeks ago. There are a number of important stories which emerged during the first week. I've included those stories in today's show, but to distinguish them from this week's stories, they're marked as catch-up stories on the relevant slides. The US Trade Representative's Section 301 public hearing in regard to France's digital services tax is scheduled for next Monday. At last count, 16 organisations and individuals had submitted public comments. For a copy of those comments, please go to our website or app. Meanwhile, African countries are debating the various proposals in the Inclusive Frameworks Digitalisation project. The African Tax Administration Forum has released a technical note on this issue, and a non-government organisation, the International Centre for Tax and Development, has posted several blog comments which reflect a concern that the position of African countries might not be appropriately addressed in the final global solution. For a copy of these documents, please go to our website or app. The US Treasury and IRS have released proposed regulations in regard to the classification of cloud transactions for the purposes of the international provisions of the US Internal Revenue Code. The proposed regulations also amend the existing regulations for classifying transactions involving computer programs in a number of ways. Most importantly, by applying the rules to transfers of digital content. The relevant international provisions include the rules for determining the source of different types of income, which then impact US withholding tax obligations and foreign tax credit calculations. Subpart F income, the BEAT tax in Section 59A and the Section 250 deduction, which is relevant to both FDII and GILTI. For a copy of the proposed regulations, please go to our website or app. Let's start with a quick summary of the existing regulations in Section 861-18. They classify transactions involving computer programs into 4 categories: transfer of a copyright right in the computer program, transfer of a copy of the computer program, a so-called copyrighted article, provision of services for the development or modification of the computer program, and provision of know-how relating to computer programming techniques. The first 2 categories each contain 2 subcategories: a sale or exchange of the copyright right or the copyrighted article, or a license of the copyright right or a lease of the copyrighted article. The proposed regulations will expand Section 861-18 to cover digital content, and they propose to do that in the simplest way. All references to computer program will be replaced by digital content. So, for example, the first category of transactions, transfer of a copyright right in the computer program, will become transfer of a copyright right in the digital content. The term digital content will be defined in this way: For the purposes of this section, digital content means a computer program or any other content in digital format that is either protected by copyright law or no longer protected by copyright law solely due to the passage of time, whether or not the content is transferred in a physical medium. For example, digital content includes books in digital format, movies in digital format, and music in digital format. The proposed regulations ask for public comments on whether the definition of digital content should be broader. The existing Section 861-18 contains 18 examples. The proposed regulations will add 3 more. One on electronic books for download, another on memberships which provide end users with unlimited access to a catalogue of copyrighted music in exchange for a monthly fee, and a third on unlimited access to a catalogue of movies and TV shows with 3 viewing and price options: a streaming option, a rent option, and a purchase option. The analysis of the streaming option in example 21 is interesting. For transactions under the streaming option, there is no transfer of any copyright rights. There is also no transfer of a copyrighted article because the content is not downloaded by an end user, but rather is accessed through an on-demand network. The transaction also does not constitute the provision of services for the development of digital content or the provision of know-how. Therefore, none of the 4 categories in Section 861-18 applies to such transaction. Instead, the transaction is a cloud transaction that is classified under Section 861-19. One other important amendment should be noted. The proposed regulations will include a place of sale rule in regard to sales and online transfers of copyrighted articles. When a copyrighted article is sold and transferred through an electronic medium, the sale is deemed to have occurred at the location of download or installation onto the end user's device used to access the digital content. However, in the absence of information about the location of download or installation onto the end user's device used to access the digital content, the sale will be deemed to have occurred at the location of the customer, which is determined based on the taxpayer's recorded sales data for business or financial reporting purposes. Proposed Section 861-19 defines the term cloud transaction in this way. A cloud transaction is a transaction through which a person obtains on-demand network access to computer hardware, digital content, as defined in Section 861-18A3, or other similar resources, other than on-demand network access that is de minimis, taking into account the overall arrangement and the surrounding facts and circumstances. A cloud transaction does not include network access to download digital content for storage and use on a person's computer or other electronic device. Proposed Section 861-19 classifies cloud transactions into either of 2 categories: a lease of computer hardware, digital content, or other similar resources, or the provision of services. That classification is to be done according to 9 factors. Here's the first 5 of those 9 factors. Please hit the pause button to study the list. And here's the remaining 4 factors. Again, please hit the pause button to study this list. Proposed Section 861-19 includes 11 examples on various topics. Please hit the pause button to study this list. I've highlighted examples 5 and 10. Both of these examples involve the downloading of software or digital content onto the end user's computers. That activity does not constitute on-demand network access. Therefore, the transactions are not cloud transactions. Instead, they're covered by Section 861-18. I've also highlighted Example 8, which involves two elements: the provision of downloadable software plus access to online data storage, with a separate price for each element. The data storage is a cloud transaction, which is covered by Section 861-19. However, the software download is not a cloud transaction and is therefore covered by Section 861-18. The US Trade Representative has released details on the additional tariff of 10% on $300 billion of Chinese imports into the US. The most important point is that the tariff increase will be introduced in 2 steps. For most of the relevant products, the extra 10% will go into effect on the 1st of September. But for certain products, such as cell phones, laptops, video game consoles, certain toys, computer monitors, and certain items of footwear and clothing, the extra 10% will apply from the 15th of December. Yes, that's right, so as to not impact Christmas shopping. For a copy of the USTR announcement, which includes the 2 lists of products, please go to our website or app. The European Commission has imposed countervailing duties of 8% to 18% on imports of subsidised biodiesel from Indonesia. For a copy of the Commission's announcement, please go to our website or app. And the OECD has published the first batch of Stage 2 peer review reports on BEPS Action 14, which deals with improving tax dispute resolution mechanisms. The reports cover 6 countries: Belgium, Canada, the Netherlands, Switzerland, the UK, and the US. For a copy of the reports, please go to our website or app. In Australia, the High Court has refused to grant an injunction to prevent the Australian tax authorities from using documents which were publicly disclosed as part of the so-called Paradise Papers. Those documents were stolen from the Bermudan law firm Appleby. The request for the injunction was on the basis of legal professional privilege. The court accepted that legal professional privilege does apply to the documents. However, it held that that privilege is merely an immunity against disclosure. But the problem for the taxpayer was that the documents had already been disclosed to the tax authorities, and there was no allegation concerning the tax authorities' conduct or knowledge. The court held that legal professional privilege does not allow injunction relief to prevent the use of documents which had already been disclosed. Interestingly, the court made an observation that the taxpayer did not seek to rely on the equitable doctrine of breach of confidence. If you'd like to read this case and the press release from the tax authorities, you can find a copy of both at our website or app. Also in Australia, the government has changed the way it implements its deemed source rule in regard to double tax treaties. The deemed source rule addresses the situation where a treaty allows Australia to impose tax on an item of income, but the Australian domestic tax law does not actually impose tax on that income because it is not derived from an Australian source. To close that gap, Australia's treaty policy has been to include in treaties a provision which says that items of income which the treaty permits Australia to tax are deemed to be derived from an Australian source for domestic tax law purposes. You might remember that such a provision was applied by the Australian Federal Court in the recent Satium case. For those treaties where it is not possible to include such a provision, which would include those treaties where the treaty partner does not accept the provision, Australia has achieved the same outcome by including an equivalent provision in the legislation which gives the force of law to the treaties. Such legislation has been on a treaty-by-treaty basis. Well, the Australian government announced in this year's budget that it will streamline the whole process. The provision will not be included in treaties which are signed on or after the 28th of March 2019. And instead of treaty-by-treaty legislation, there will be a single provision in the legislation which will apply to all treaties which are signed on or after that date. That single provision is contained in a draft bill which the government has now released. For a copy of the draft bill and its explanatory materials, please go to our website or app. It's important to note that this provision should not be viewed as a treaty override. The explanatory materials include this statement. This new approach means that Australia will no longer need to secure agreement to include its specific source rule in the course of negotiating a tax treaty, or legislate a specific rule where such agreement cannot be secured. This is appropriate as the characterisation of source and other matters that go to establishing a tax liability are ultimately a matter for the domestic laws of each contracting state. And finally, in regard to Australia, a senior tax official has given an interesting presentation on transfer pricing risks in Australia. What's particularly interesting is his comments in regard to so-called channel profit. For a copy of this presentation, please go to our website or app. In China, the State Council has issued an overall plan for the new Lingang area of the Shanghai Free Trade Zone. According to an article published by the state-run Xinhua news agency, income tax shall be levied at a reduced rate of 15% for 5 years from establishment for qualified enterprises engaged in manufacturing and R&D in key fields including integrated circuits, artificial intelligence, biomedicine and civil aviation. For a copy of the article, please go to our website or app. In India, the government has released guidance in regard to the difficult question of whether services performed by an Indian company for a non-resident client are in the capacity of an intermediary for Indian GST purposes, in which case the services will not be zero-rated and will instead be subject to 18% GST, which would be an additional cost. You remember that this question has caused confusion ever since an unfavourable advance ruling was issued to vServe Global in November last year, and then confirmed on appeal earlier this year. Well, the new guidance contains some good news and some bad news for Indian service companies. The good news is that back-end services which fall within the definition of information technology-enabled services under India's transfer pricing rules will not cause the service company to be an intermediary. However, the guidance states that the service company will fall within the intermediary definition in this situation. The supplier of back-end services located in India arranges or facilitates the supply of goods or services or both by the client located abroad to the customers of client. Such back-end services may include support services during pre-delivery, delivery, and post-delivery of supply, such as order placement and delivery and logistical support, obtaining relevant government clearances, transportation of goods, post-sales support, and other services, etc. For a copy of this guidance, please go to our website or app. In New Zealand, the Supreme Court has had the final word in the Chatfield case, which concerns the New Zealand tax authorities' attempt to obtain information to exchange with their Korean counterparts. The New Zealand tax authorities lost in the two lower courts, most recently in the Court of Appeal. Well, the Supreme Court has now dismissed the tax authorities' application for leave to appeal to the Supreme Court. And also in New Zealand, the tax authorities have released guidance on the recent amendments which will apply GST to imports of low-value goods effective the 1st of December. For a copy of the guidance, please go to our website or app. In France, online marketplaces will be given VAT verification responsibilities in regard to foreign vendors on their platforms, effective the 1st of January 2020. EU member states are required to introduce VAT obligations for online marketplaces by the 1st of January 2021. A similar regime is already operational in the UK and Germany. In Italy, a requirement for online marketplaces to report on a quarterly basis transactions by third-party vendors has begun, with the first report due on the 31st of October 2019. And in Austria, an on-request reporting regime by online marketplaces will commence on the 1st of January 2020. In France, the tax authorities have issued guidance on the VAT treatment of initial public offerings of cryptocurrencies. For a copy of this guidance, please go to our website or app. In Germany, the Ministry of Finance has published a draft bill which would significantly reduce the 5.5% solidarity surcharge which has operated for over 20 years. But there will be no reduction for corporations. In Kosovo, the corporate tax loss carry-forward period has been reduced from 6 years to 4 years, effective the 1st of January 2019. In Lithuania, a VAT reverse charge mechanism will commence on the 1st of September in regard to laptops, mobile phones, tablets, and hard drives. In Luxembourg, the government has introduced into Parliament a bill to enact the hybrid mismatch rules in ATAD 2. The provisions in the bill will apply generally from the 1st of January 2020 and from the 1st of January 2022 for reverse hybrids. The bill strictly follows and does not go beyond ATAD 2's minimum requirements. In the UK, the upper tribunal has decided a VAT case in regard to an employee salary sacrifice scheme. Under the scheme, participating employees are required to make a payment called an MAP adjustment to the employer company. The issue in the case was whether the MAP adjustment is in consideration for a VAT taxable supply of services by the employer company to the participating employees. The upper tribunal held, firstly, that there was no supply of services by the employer company to the participating employees. And secondly, the employer company was not carrying on an economic activity in regard to the salary sacrifice scheme. Accordingly, there was no VAT output tax on the MAP adjustment. For a copy of this case, please go to our website or app. The International Centre for Tax and Development has published a paper called Safe Harbour Regimes in Transfer Pricing, an African Perspective. The paper recommends the cautious adoption by African countries of safe harbours in their transfer pricing rules in order to approximate an arm's length outcome, but without the difficulty and expense of undertaking detailed comparability studies. For a copy of the paper, please go to our website or app. Now, this is getting ridiculous. For the third time, Zambia will postpone the introduction of a new sales tax to replace VAT. The original start date was the 1st of April. It was then postponed to the 1st of July and then to the 1st of September. It's now proposed to introduce the legislation in September with a start date of the 1st of January 2020. In Zimbabwe, the government has presented its 2019 mid-year budget review and supplementary budget. A number of interesting tax changes were announced. I'll quickly run through the list. The country's income tax law already has a deemed source rule in regard to outbound fees paid for satellite broadcasting services and e-commerce platforms. However, the scope of this deemed source rule will be increased to cover other digital services. There are two interesting changes in regard to the capital gains tax rules. Firstly, instead of calculating the tax on the gain, a 5% tax rate will apply to the gross disposal proceeds. And secondly, an exemption from capital gains tax will apply to disposals of assets to sovereign wealth funds. And mineral royalties, which are paid to the government, will become tax deductible for income tax purposes effective the 1st of January 2020. In Bahrain, the tax authorities have issued two items of guidance in regard to VAT. The first is an updated version of the VAT General Guide. The most significant change in this updated version is in regard to the formation of a VAT group. And the second item of guidance is a VAT Transportation Guide. For a copy of both of these items, please go to our website or app. And in Kyrgyzstan, the tax authorities have released guidance on the tax incentives available for qualified industrial enterprises. For a copy of the guidance, please go to our website or app. In the US, the Altera case in regard to employee stock options and a cost-sharing agreement is being closely watched. You remember that the company, which lost 2-1 in the Court of Appeals for the Ninth Circuit on the 7th of June, has filed a petition asking for an en banc review by the Ninth Circuit. Well, that petition has now been supported by a large number of companies, organisations and other parties. Here's a list of supporting briefs which have been filed. Please hit the pause button if you'd like to study the list. For a copy of these 6 briefs, please go to our website or app. And despite the fact that Altera's petition for an en banc review is still pending, the IRS has resumed the making of adjustments based on the regulation under challenge in the case. Such adjustments had been suspended in January 2018. For a copy of the recent IRS memorandum on this topic, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties signed, 1 protocol signed, 3 treaties enter into force, and 3 protocols enter into force. I have 2 articles for you this week. The first article is called Globe and the Supranational Nudges Affecting Domestic Tax Policy. It's written by Lucas de Lima Carvalho and it's published in the Tax Notes International Journal. This article describes and criticises the proposals in Pillar 2 of the Inclusive Frameworks Programme of Work on Digitalisation, commonly known as the Global Anti-Base Erosion Proposal, or GLOBE. A good example of the criticism is this. The OECD presents GLOBE as a response to concerns presented by certain members of the Inclusive Framework on BEPS regarding the ongoing cases of profit shifting that still threaten their tax bases post-BEPS. It claims that countries should agree on a coordinated approach to address these concerns, instead of adopting unilateral actions. The argument is used to support a set of rules that, much like blacklisting and the peer-to-peer assessments under BEPS Action 5 on countering harmful tax practices, are retaliatory measures tailored to pressure countries, especially those that have developing and underdeveloped economies, to conform to particular tenets of domestic tax policy that may very well be detrimental to their own economic, budgetary, and even social welfare objectives. The second article is called How the Vodafone, I'm not even going to try to pronounce the next word, opinion affects EU debate on turnover-based digital taxes. It's written by Leopoldo Parada and it's also published in the Tax Notes International Journal. This article considers the opinion of EU Advocate General Julianne Cocotte in an ongoing freedom of establishment and state aid case concerning Hungary's turnover-based telecommunications tax. It discusses whether that opinion provides useful guidance in regard to whether a digital services tax, like the one recently enacted in France, is susceptible to challenge on the same grounds. Well, that's the way it is this Friday, the 16th of August, 2019. I'm Steve Towers in Bangkok. Have a great weekend.